Hello, I am Lori Ellis, Head of Insights at BioSpace. As part of our pre and post JPM coverage, we are here today to discuss the alternative funding sources and strategies available to companies navigating the current and future economic climate, as well as discussing potential risks. Today, my guests are Jeff Burton, CFO at Helia Therapeutics, Karen Harris, CFO and Head of Mission-Related Investing at Alzheimer's Drug Discovery Foundation, Rob Williamson, President and COO at Tremera Immunologics. So let's dive into this discussion. And Karen, I'm going to start with you first. Could you briefly talk to me about what the current economic climate is now and then predictions for the next 5 years?
Sure, thank you. So I don't think I need to tell anybody that it's been a very rocky climate in both the private and the public financing markets. The indices are down 50% from 2021, and the IPO markets are pretty much closed compared to the boom years of 20 and 21. And venture capital funding is very hard to access as well. The VCs are unable to take their companies public, so they're financing their existing portfolio as opposed to making new investments. I am optimistic, though, for towards the end of 24 and 25, interest rates do seem to be coming down and are projected to come down, and I think this will make the biotechs more attractive. In the next 5 years, I see a very promising role for biotechs. I think that there's going to be great changes with AI in how companies do drug discovery and clinical trials and develop biomarkers. I think there'll be advances in technology. The IPO market and M&A markets will open. In fact, I think the M&A market has already started to. And we have an aging population. So I think the products of biotechs are going to be ever more needed.
Okay, Jeff, Rob, would you like to chime in from your perspectives as well?
Sure. I mean, as far as I'll chime in. I was actually at a conference last week and heard from a lot of economists from some of the leading banks, and most of them talked about 2024 with cautious optimism. So yeah, inflation, interest rates are stabilizing the latter half of this year, but they're still cautious about next year just because of geopolitical instability and the market volatility we've experienced for the last 2 years. But at Helia Therapeutics, we're optimistic about next year, both from our company perspective and on a macroeconomic level. We hope that the markets open up and if the opportunity looks promising, that there might be something that we could do. But I think, as Karen mentioned, that the IPOs are down significantly, and particularly in biotech, and hopefully next year that changes as we get a little bit more stability and more opportunity for companies, in our size similar to Helia Therapeutics.
Well,
yeah, I don't have a ton to add, but I would say that this time last year, everyone was saying, hopefully next year will be better. And it didn't get better. And I try to think back over time for pattern recognition. It feels kind of like it did in 2003, 2002. Feels like we're in that same sort of type of trough, and pretty substantial. The IPO market didn't really recover for many reasons that entire decade. There were other financial crises, you may recall, if you're old enough to. And it really took something like the Jobs Act and things like that to turn things around in the early 2010s for the IPO market. I don't think we're in the same boat here necessarily, but I think there are the macroeconomic issues, global instability, potential conflict in several fronts, interest, which could impact certainly the IPO markets. I think interest rates will be going down. I think I have been confident that we'd have a soft landing although some economists are still saying there's going to be a recession, gosh darn it. I feel like they're trying to manifest it. I'm like, I think we're going to have a soft landing. So I do think there will be an opportunity for companies to go public, and therefore the trickle down to private financings will happen. Will it be in 12 or 24 months? That's sort of my personal takeaway right now. I am optimistic, and certainly the week we're recording this, there's been some significant transactions. M&A often leads the IPO world, right? So if we can start seeing those transactions happening, I think the markets will open up for biotech. And yeah, I'll stop right
Okay. So then there's cautious optimism right now. So we're going to talk about how companies are able to maneuver in the current economic climate. And I'm going to start with Jeff, because you've had some interesting approaches to approaching funding and then also your closes.
Sure. So yeah, for those that we haven't talked in the past, we recently we've been doing a Series C round of preferred financing. And it's in the past, our rounds were one, maybe two closes, but it was a very, set process, and we knew when we were closing, and it was a fairly, I don't want to say painless process, but compared to the C, they were relatively, easy. But with the C, we had our attorney luckily was wise enough to say, let's leave this one open. Traditionally, we haven't, but let's leave this open for 120 days from the initial close, which was, something that, again, we hadn't done, but allowed us to have rolling closes, given that, we had our first close in December of last year. And then things, as Robert mentioned, we thought this year would get better, and it didn't. And so things were difficult, but we were able to do rolling closes, and we had that in place from the beginning. So, our shareholders knew that was what was going to happen, and participants in the, in the round knew that we would continue to have closes up until, the 120-day mark. And fortunately for us, that, we were able to raise the funds that we needed to, and despite the difficulties, had a successful round. So.
Rob, I'm seeing you nod. Do you think this is a good strategy? And what other strategies do you recommend?
Well, I'll say Triumvir's Series A was 3 massive closes over time. Our Series B had 2 closes in it, and it's probably could get reopened for the right investor and the right amount. So we've done the same thing, and I think the lesson is, in this environment, you need to be flexible and endure some, I think, the allusion to pain and the financings and how to get them done. And it makes sense. And then the other ways to raise money are obviously partnerships, non-dilutive capital, things like that. And people are looking at those. But as we have seen a dearth of M&A until very recently, we've seen a dearth of meaningful deals in the space as well. This past year has been pretty modest, and I remember in January people were really hoping JP Morgan would see some great, really transformational deals in 2023, and it didn't happen. So I'm hoping 2024's JPM's a little more fruitful for our companies, because it sends a signal to everyone, and we'll see how the week plays out.
Aaron, what are your expectations based on the M&A deals, but let's also talk about some of the rolling closes that are happening now, reopening closes, and what you're seeing from your perspective.
I'm seeing a lot of different strategies from our portfolio companies. I am seeing a lot of down rounds, which means really that the price of the preferred stock you're offering is lower than the price of the last deal you did. I've seen bridge financings where they issue convertible notes just to bridge them over into actually do a preferred deal. And we're seeing a lot of companies who need money quickly and aren't going to be able to close their Series A or Series B right away. And ADDF does a lot of those bridge financings. I've seen divestiture of non-critical assets, some licensing deals, mergers of one product companies together to form a better, more attractive company. And then in the public markets, I've seen PIPEs, which are these private investments in public equity. And basically that's when the public markets are not somewhere you want to issue stock because your stock is doing terribly badly. You can sell a block of stock to a private investor, and ADDF purchases some of these PIPEs as well.
Rob, I see you nodding over there. Would you like to add something?
Karen reminded me that you can also, there's venture debt out there. And despite the collapse of SVB, that didn't mean the people who did venture debt went away. They just spread all around. And so if you have a sort of a development program with a timeline and or a partnership with a milestone coming down, but you don't have enough money to get there, venture debt can make sense. And those, I tend to avoid it, but in the right circumstances, venture debt can be that bridge. So instead of doing a convertible note, you draw debt to another financing or a payout from a partner. So that's been very interesting. Also, I think on the public side, one thing I'd say is a lot of people are doing ATM vehicles as well. So and just those are effectively at the market. It's a vehicle to raise money on an ongoing basis at a price that the company accepts. So it's I've seen those going as well on the public side.
So Jeff and Rob, sorry, you both have had other companies approach you for partnerships, and I would like to know from either of your perspectives, what are you looking for in a partner? And what are the pros to working with a partner? And then what are some of the cons?
Rob, I'll let you go first.
I'll be careful here because I don't want to say anything about Triumvira and our partner. So I'll speak from past experience. I think the best partnership as structured is financially and mission aligned. So you both are going at in the same direction. There's fair economics for both sides, so it's sustainable. Because you can build resentment over time. And frankly, where one partner brings certain skills and the other others. And typically in biotech, there's really innovative research, but you're not good at translational. You don't have quite the chops clinically, and a partner can help you there. And those feed off each other. The challenge I've seen myriad times in these partnerships with a larger partner is a change of mission at the bigger company, right? The biotech's always like, I want to do whatever it is. And you do a deal with a partner, and the people who'd struck the deal go to another firm, or they reprioritize pipelines. And look at pharma right now, the pipelines are getting reprioritized left and right, which is leaving, frankly, quite a few companies, I think, who have partnered with them. They're either announcing the deals are off, or they're just, the partnership is really non-productive. It may still be going on. So it's really a change of mission over time, and that often is driven by either personnel changes at the partner or macro environment issues, and they say they're abandoning a sector or what have you.
Yeah, and I would just, a lot of the points that Rob touched on kind of bring up not so pleasant memories from prior experiences, not specifically to Halia, but in my, prior companies. He mentioned financial, being fair financially and leading to some resentment. If the team changes, the focus changes, the speed is not what you expect. Here at Halia, we're small and nimble, and we're flexible. We can move quickly. So we know that if we, hopefully, if there's a partnership that we enter into, we have to remember that we're dealing with something that moves much, much slower, but they do have the chops to help us clinically and from a scale perspective, but there can be, you got to remember that, yeah, the teams might change, the financial aspects might change or might be skewed a little bit in the future. And you might feel that resentment. I have felt that in the past, I'll be honest, and it was challenging, but the positives, I think, specifically for a company like Halia that's small and is trying to do a lot, we could do much more with a partnership with larger pharma. So some of those negative aspects, yes, they'll probably present themselves, but hopefully the positives will outweigh them if you get the right deal.
Karen, you also mentioned mergers. I'm going to ask all three of you, have you seen or have you noticed there are more mergers of, creating these better products together?
We've just seen two big merger or acquisitions by AbbVie of Immunogen for $10 billion. Then we've seen AbbVie's acquisition of Cerevel for $8.7 billion. Merck just bought Caraway Therapeutics, which for $600 million. And what's interesting is two of those companies are neurologically focused, which is something we haven't seen before because that's considered quite high risk. So I think we are seeing more mergers in the market. And as I think Rob said, we do tend to see the M&A market improve before the IPO market does. And perhaps that's some of what we're seeing. I think also there's increased interest in Alzheimer's just because of the two recent drug approvals. And I think some of what we're seeing is just a change of heart among VCs and possibly even companies as to whether they want to focus on neurological diseases.
Fantastic. I know Rob and Jeff, you were nodding as well. Are you agreeing or do you have anything to add? Okay.
Yeah, I won't add too much. I think, that there's been a few deals that we've, had particular focus on, but, I think, hopefully there'll be even more, M&A events into 2024, and hopeful that, that will lead to, again, opening of the market. But I would hope that after JPM, we see some increased activity.
I mean, there are a couple really hot areas right now. Nuclear oncology, the GLP ones, weight loss. I'm really happy to see some CNS deals for the sector, right? It's fantastic to see. And what that says to me is there may be a broader appetite, right? Because those are riskier deals. And it has struck me over the last year, the deals that have been done have been relatively low risk pharma deals, and that the migration towards a little more risk would be very beneficial for the broader biotechs. Yeah.
So Rob, I'm going to ask you another question. You talked about misalignment. Can you talk a little bit about misalignment when you're working with alternative funding, when the company's alignment is different than the mission that they initially started with? Can you talk about a little bit about what challenges that may present, if any?
Sure. Yeah. Even Triumvira took early funding. The Series A we had, some of the foundations involved in liquid tumors invest in Triumvira with cell therapy. There's quite a few CD19, BCMA areas for liquid tumors, and Triumvira migrated away from that and is focused on solid tumors. So one of our early investors, their mission was let's cure liquid tumors, and we're not doing it anymore. It doesn't mean it's not happening in the market. Frankly, we're not doing it because it's very crowded, and it makes sense for us as a company. But we're just not aligned with their investment thesis, and their money went in. So that can happen. It happens not only with sort of mission-oriented foundations, but also partners. And I've worked with family offices in the past, and I think the misalignment is if you take a family office who has a passion around a disease state, typically because someone in the family has that disease. The challenge there is they just don't understand drug development fundamentally. It's a foreign concept, the amount of money and time it takes. And family offices are often there because they've been very successful in a more traditional business. And so I have cautioned certainly founders, scientific founders who say, well, I've got this family office and I'm working on disease Y, and this family office cares about disease Y, and they're offering me the seed money I need to really go forward. And I say, well, they don't understand biotech investing. And the other thing is having a family office like that who is not an informed biotech investor can scare off your next round, right? The venture capitalists don't want to come in and and basically haggle with the family office over the proper A rent. So there's, I think, some danger there. I think the foundations are frankly better at managing that transition to traditional venture investors when they come in early. They know what they're doing now, typically the larger foundations, but the family offices still don't.
Jeff, have you experienced this as well?
Yeah, I would, echo that. We, our founders were wise at the time to, 'cause we did have a number of family offices come in that were focused on particular areas of therapy or an indication. But our founders were very clear that, we're very early. We have a few targets and things could change in 3 months. We could get our seed money and we could be shifted in 6 months time. But they set the expectation early with them because, like, Rob mentioned, that a lot of them have not done biotech or pharma. They haven't had this experience. They have a traditional business where they made their money and are now investing in new industries. And so, that was something that we kind of set the precedent early. And so that's been good. We have had to make some changes and shift and have new opportunities, and they've been very supportive of that. And as far as, with different groups and foundations, we did approach a few early on, but we've been more into discussions with those types of groups as we've gotten closer to phase 2, which is where we're going to be focusing on particular areas of therapy or indications. So it's I don't think we'll have, obviously things can still change as we get into the clinic, but into phase 2, but it'll be I think it'll be easier to align with our mission with theirs, and then work together to achieve that mission once we've got enough focus with the phase 2 clinical trial.
And I see you've unmuted, I'm going to come to you. So I have a couple questions for you. One, have you experienced misalignment? And then 2, have you experienced working with some of these family investors or these family office investors? And is that a factor when you're looking to invest?
I think when ADDF wants to invest, we like to see some venture capitalists in there already. That gives us assurance that the science has been vetted, that some diligence has been done. Although we do a deep scientific due diligence ourselves, we tend now to invest at the clinical level. So we tend to not be seeing these seed rounds where just family offices are investing. We used to invest more in preclinical, but as the science has moved, we're now really investing 80% in clinical. And we tend to see mostly VCs already in there.
So then you mentioned a little bit of what you are looking for when you're approaching investing with a company. One, how has your evaluation changed from prior years due to the climate? And then what are some other elements that you're looking for?
Well, I would say that at ADDF, because we're a venture philanthropy, the science comes first. That's the most important thing for us. And we're looking for promising and innovative science for Alzheimer's based on the biology of aging. And once the science is fully vetted, we're looking for companies that when we invest, we know that they're going to be able to sustain themselves and actually make use of our investment. So we invest in specific projects, and we like to make sure that the company is going to have enough resources to complete the project and to continue. And often we're really looking for the financial plan that says, well, this is how we're going to, if we bridge the company, this is how we're going to raise the Series B, and what is the scientific evidence that's going to get investors excited. So I think more and more we're doing a lot of bridges, and we have to be particularly careful that we're ultimately going to end up converting into equity as they raise their rounds.
Rob, you've been through this process, and as has Jeff, and I'm coming to you first. So what do you recommend for companies right now that are seeking funding or seeking bridge funding, or honestly, even a partnership? What kind of things would you be evaluating or you suggest companies do?
Well, I guess I'm going first. Karen actually brought up an important word: get the investors excited, and it is really, really hard to get investors excited these days. You have public companies where they're returning capital to the investors. So instead, there's reverse mergers out there that end up just the existing investors say, forget it, we're going to take it private and disperse funds back. So money from the investor side is being pulled out of the market, right? So I sort of equated to the calories in the biotech universe are being diminished. So your story does need to be incredibly compelling and exciting, or in an area that's perceived as de-risked. And there are a couple areas that the momentum's in right now, and I think lesser companies are able to get funding there. And then in terms of excitement, what does that look like? Unfortunately, right now there's two. I see the two investable theses in biotech right now are either you're in the clinic and you're getting proof of concept data and you're building on that, and that's exciting, or you're really an early, completely novel, innovative technology, and someone's into whatever you're doing. There's a lot of money in aging, as we brought up early on. There's a lot of money here and there. So those are the two. It's a barbell set right now. If you're in the middle, you're really in a tough spot.
That is actually the area where ADDF does tend to invest, in the sort of valley of death. And one thing we do find is that if ADDF invests, then that comforts other investors, VCs, because they know that we've done good scientific diligence. So we kind of see ourselves as a stamp of approval for people to come on in. But as Rob says, you really need an inflection point where data is going to be revealed or something exciting is going to happen to get the VCs to want to commit new money to your company.
Jeff, do you agree, or do you have anything else to add?
No, I agree with everything that's been said. As Karen mentioned, I think we've talked here at Halia and prior experiences working with groups such as Karen's. Obviously, they bring a lot of scientific validation. So if you're able to get one of them early on, all the better. And as they mentioned, if you're building towards some inflection point, and you can get one of those groups to come in, vet the science, and decide to participate, that also helps build the excitement. If you're able to share that information with other potential investors. But I think, it's a that's kind of where we were at this last year, as we were building towards completion of a phase 1 and getting into a phase 2 and getting the investors excited about the opportunity to be here as we build that value and get into phase 2 and a POC and go from there. So before that, prior to that, it probably would have been much harder to raise what we did without that opportunity coming.
So Karen, and I'm going to ask everyone in the panel as well. What is different with working with an organization as an investor versus a VC? What are some of the benefits? And then what are some of the potential challenges that you see that companies often struggle with?
Well, starting on the VCs, one thing I would say is they're a great source of capital to advance drugs through the pipeline, and they bring a lot of expertise. And basically, they want you to succeed because they want to succeed, and they want to deliver returns to their limited partners. And they can provide follow-on funding to you as well. So I think that VCs make very good partners. And most of the time, their interests are well aligned with the company. Not on occasion, that's not the case, but I think typically they want you to succeed, and they will work hard with you to do that. I think partnering with pharma can also be extremely helpful because of their expertise. They can help you structure your clinical trials. They can bring you contacts. They could bring you customers. So I think that partnering with a company can be a very good, interesting way to do things. I think maybe one of the downsides of partnering with a company is that while on the upside, they could license your product eventually or acquire you. On the downside, sometimes it looks bad if they don't. And so I think that might be one of the downsides to partnering with a company.
Yeah, I experienced that firsthand, where I had a build to buy with Celgene, and Celgene effectively then BMS, and then they abandoned effectively that therapeutic space, and it really put a storm cloud over the programs that they walked away from, despite them being frankly pretty interesting and compelling programs. It just, and they knew that would happen too. So they said, we know if we walk away, it's going to taint these programs. It just does. So I think that's a very important thing to keep in mind. And if you have really good investors behind you, they can help you finance and weather the storm and repurpose those programs and get them back into sort of the away from the rain cloud, so to speak. And that's the important thing about having a strong investor syndicate. And I think VCs, the best venture capitalists, not only have money that they can put in, but they can help you syndicate your financing as well. And that's really important.
So you're recommending an, I would say, not expansive network, but making your network as broad as you can for when you're doing investments in case a storm cloud would happen.
Yeah, the best, if you have five, there's pros and cons to having a lot of people around the table. It's like herding cats sometimes. And investors have different investment timelines, right? So some want to get an exit now, and some are in it for the long haul and happy to ride the upside. So you have to, ideally, you have, in my mind, as a private company, about 3 really deep-pocketed, strong investors leading the charge who have a similar alignment time frame. They can bring in other folks as well, and then frankly, the sooner you can build the value and then go public and then go into the public markets, I think the better for everyone around the table. That hasn't happened, right? So right now, the private companies are all dealing with a tougher environment. But yeah, I do think having a handful or less of really strong investors around the table can help you manage adversity.
It's interesting. Rob talks about companies and how you should go into the public markets, but I think in 20 and 21, too many companies
that was
Yeah.
too many companies went into the public markets, and now they're suffering. Many of them are trading below $1. They're about to be delisted from NASDAQ, and we've seen reverse stock splits to try and correct that, which haven't worked. And so I think that some of those companies went in too early, and as a result, now nobody's willing to take that risk anymore.
Yeah, it was, there were, and Jeff was probably gonna say, I was stunned at some of the companies that went out, just in terms of their pipeline and
how early they were, right?
Yeah,
I mean,
it was just like
so many preclinical companies. It was baffling to us, but
yes. Yeah, I'm thinking more like you're in the clinic, you have already some proof of concept data, you're maturing your pipeline. That's where my mind is. I think if you're clinical, your story is it's going to evolve too rapidly for the public markets to tolerate.
Yeah, and I think that 20 and 21 impacted our round, because we went out, we went through a great process to decide, what the valuation was, but with several VCs and groups, it was, well, I can go and buy 2 or 3 companies at that price. And obviously the science, we could say, well, we're further along. Our science is strong, but it did impact us negatively that all those companies went out and then were, underwater and trading below cash, and yeah, it didn't make it any easier for us that happened. But
Triumvira, we're actually pretty well valued in our financing, our private financing, and it's not incredibly high, but we still have the public market overhang where you can point to other cell therapy companies who are trading at cash or below cash, and it's just really challenging. Their enterprise value is negative. And as you said, Jeff, you can argue, well, our technology is better, or look at our clinical results, right? But they say, well, the public markets are speaking right now, and
Yeah.
So then what strategies do you recommend? Because we talked about, I know in some of our interviews that valuation, and then you have that valuation again and it's suddenly lower. So then how do you pivot and how do you adjust for that? Or do you?
If you need the money, you raise the money at
Yeah.
the clearing price. And some people get hurt, including the employees, right? Their options are underwater, and there are ways to remedy that, and they're not easy or fun.
So let's talk a little bit more about the venture capitalists. And sometimes it's like herding cats and their opinions. How much involvement do you see with venture capitalists now? Has it changed? As in prior years, has the economic climate made them a little more interested of every step of the way of what's going on with their companies? And I'm going to start with whomever wants to start.
Yeah.
Oh, go ahead.
Go ahead, Karen. I'll let you go.
You go. All right. I was just going to say, I think that VCs, they need their companies to work too, and they're having to give more funding to their existing portfolio companies now, and not funding that they had set aside for that company because they figured the company would be public by now. So I think that the VCs are paying a lot of attention because they are seeing a lot of problems and they have to pay attention. They have to help. At ADDF, we try to mix and match companies with VCs that we know. And, we're seeing that a lot of companies are really having trouble. They're restructuring. And so I think the VCs are having to become very much involved in that.
Yeah, I would say, just from my experience in my network, it's VC involvement has increased, as Karen said, because they're not having these exits, these IPOs that they've anticipated, and so they're being much more careful with their cash, and then that means they're being more involved in the operations of these companies, which for us, that's one thing that our founders have worked with many VCs over the years, and that's been a pain point at times when they get more involved. You feel like you're more chained up. You can't pivot. You can't be flexible, for obvious reasons. But that sometimes can result in some friction and some problems.
Yeah, I'll just add that's all true. I think investors have. I mean, there's an old saying: there's two emotions, fear and greed. We're squarely in the fear mode with a lot of folks, and when people are scared, they tend to try to control things as best they can, and I think you're seeing that across the universe. What I like to see with my investors are folks who've been there before, right? It's not the first time they've seen a cycle. Being someone who's been doing biotech as long as I have, I've seen it a couple times, right? And when I also have the same thing. There's fear, right? You're like, holy cow, these markets are horrible. What do we do? And I do find solace in thinking back. Okay, I remember when this happened before. I was in this company, and I remember there's some investors I think back to and I say, wow, they just stood firm in the storm, right? And they were calm, collected, they figured it out, they helped the management team figure it out and get to an outcome. And sometimes the outcome is science isn't working, we can't raise money, let's be efficient and wind things down. And other times we have something here, we're going to figure out how to make it work, let's all roll up our sleeves together. So that's what I look for in the venture capitalists, is the people who have that, even if they're young, they have that character that allows them to weather these incredibly trying times for some companies.
I'm actually really impressed by the biotechs that I work with and how resilient they are and how they try so hard. Like, they're not going to let anything push them down. They're going to restructure, they're going to outsource, they're going to do whatever it takes because they believe in the science. And it's incredible to watch. These CEOs are working overtime to try and fix and keep it together.
So with that, the same type of fear, I'm assuming, would apply to the alternative funding right now, because they're definitely not used to what the economic climate is right now. So some of those family offices that we were talking about before, there would be someone that you'd really have to vet as well if you wanted to approach them for funding. Correct?
Yeah.
Okay. So then I'd like to know, what are the impacts on future funding? The climate the way it is now, some of the fears that you're talking about now, is there an impact on how you see venture capitalists and alternative funding sources, including organizations, working with companies in the future? Karen, I'll start with you and then I'll just go
Okay.
down the line.
I think that the VCs will come back into biotech. It's like Rob said, there's cycles, and we happen to be in a very bad one, but I really do think that it's going to improve. We've seen this enhanced interest in neurodegenerative disease, and we have seen a lot of VCs come to us to help them vet science and who are now interested in our portfolio companies. So I wouldn't count the VCs out. I think they will come back and the markets will turn and everybody's going to love biotech one day soon.
Rob, you are next on my list, and then Jeff, you were the next one after that, obviously.
Yeah, I don't know if I have a lot to add to this one. I do think that my hope is that we don't have the same sort of euphoria. We don't swing all the way to irrational exuberance and IPOs that don't make sense. I hope there's a more measured recovery, so that we have more stability of financing going forward instead of the boom and bust cycles. It would be really nice to see that. Whether that happens, I don't know, because greed takes over. And if the IPO markets are there, then the crossover folks want to pile in and get that quick 20% bump or whatever they get on the IPO, and that feeds down into the venture side. But my hope is that we don't go into that too euphoric of a cycle, but a more measured approach to financing.
Yeah.
My going back to something Karen mentioned about CEOs doing whatever they can to keep things together. And Ali is by no means in any financial insecurity right now. As I mentioned, we had a successful round, so we're doing great. But our executive team is still, because of this, we're optimistic, but we're cautious because of all the uncertainty out there. We are looking at, other, you mentioned other groups, other opportunities that in the past at our prior companies, we didn't have to look at, regional licenses or, partnering with a larger pharma company in a specific indication or applying for grants or, those types of opportunities. And now that's something that we discuss on an ongoing basis just because of the uncertainty of what's going to happen next year. I think I'm hopeful that as Karen said, the VCs will come back and we'll see some more investment from them into the space. But if not, we're seeing a lot of companies that, in our network trying these alternatives and having success there, as she mentioned, to keep the company going and keep it together.
So I know this is being recorded prior to JPM, and I believe it'll be posted afterwards, but I would like to know, what do you expect to see out of the conference? I know that we talked about the optimism and small excitement around the M&A, but I really would like to get your thoughts about what you expect to see.
Well, I'll start. I'm hoping we see a continuation of the deals that are significant and meaningful. And I'm hoping there's there are a bunch of folks working on the deals right now and aren't going to announce them at JPM. I'm hoping that's the case because I think that just creates momentum into the new year. Last year was, as I mentioned, kind of a non-event, what was announced at JPM. And I think that set the tone for better or worse. And my hope is that we have, I don't think there'll be a lot of financings on private side announced, although some, but I would like to see some M&A and maybe big partnerships.
Yeah, I don't have anything to add to that. That's, likewise, that's what we're hopeful for. And yeah, we'll see.
I agree with Jeff and Rob, and I am hoping for ADDF that we see increased interest in the neurodegenerative disease area. I think, and as I think Rob mentioned, we're seeing a lot of interest in aging, and I'll be interested to see whether the anti-aging theme comes out at JP Morgan.
So with that, I'm going to ask you for your final thoughts. And right now, Jeff, you are first up for me, so I'm going to start with Jeff.
Yeah, I think, thanks again for having me. This has been a great discussion. I'll say that I'm optimistic about 2024. I think that hopefully with some things stabilizing at the end of this year, we'll see opportunities open up in the new year for biotech and pharma. And I think if I would just recommend companies that to keep your options open, keep your mind open to new opportunities, new alternatives to funding, because historically maybe you haven't had to look at different avenues, but this next year hopefully things pick up. But if they don't, be willing to look at those and be ready to explore those with your team, because they could be the opportunity that carries you to your next inflection point, and then you'll have the opportunity to do your more traditional funding opportunities.
Rob?
I don't have a lot to add, other than I do think I'm hoping we have a measured recovery over the next couple of years. And as I tell many biotechs, the key to a successful biotech is that you remain alive and operating at some points, right? So it's the longer that you live, the more likely you'll be successful. And that's the key. So to Jeff's point, if you can find money somewhere that you need, get it and keep going and measure your operation accordingly.
Yeah.
I agree with both those points. I think my last thought would be that at ADDF we really feel your pain, and we're seeing it in a lot of our portfolio companies. And I just want to say, hang in there, it will get better. And we're really hoping with interest rates coming down that it's going to be sooner rather than later.
Okay. Well, I would like to thank all three of you. Thank you, Jeff, Karen, and Rob, for participating in the discussion. Additionally, I would like to thank Russo Partners for collaborating with BioSpace on this panel. And then on behalf of BioSpace, I wish to our audience to have a productive and good day.